Today's podcast is brought to you by Freetrade, the commission-free investment platform. Head to freetrade.io/pensioncraft and get started today. Designing an investment portfolio that matches your goals is hard. Sticking with it through thick and thin is even harder. Today, we're delighted to be joined by the creator of Portfolio Charts to discuss how to pick your perfect portfolio.
We'll break down how to think about risk, return, drawdowns, and crucially, your own behaviour, so you can find something that truly fits you. And in today's dumb question of the week, does rebalancing improve returns? All right, let's get into it. So we're delighted to be joined again by Tyler from portfoliocharts.com. Now, for those of you who haven't listened to our first interview with Tyler, he's the king of the backtest and has probably looked at more portfolios in his life than anyone I know. So thanks so much for joining us again, Tyler.
Oh, thank you. It's awesome to be here. I think that's the first time I've been called king. I'll take it. But it's an honor to be here, and I love talking about this stuff.
So in our first conversation, we really thought about how to design a retirement portfolio that you can live sustainably on. But let's broaden the discussion a bit this time. At a top level, what characteristics does a good portfolio even have? What's it trying to do?
That's actually a good question. That could go multiple directions. So from a practical perspective, which is where most people start, just having, a low-cost index funds that you leave alone or rebalance, that's a type of portfolio, at least that's my expertise that I can speak to most confidently. When you're getting to characteristics of what a good portfolio should look like, it gets a little more specific. Like if you look at what is in a portfolio, I think stocks and bonds and real assets and a good mix of more diversified things a lot of people commonly talk about is something that's really helpful. But if you really want to talk about characteristics in terms of behavior, which I think it gets more interesting, is for me, the thing that I'm most interested in is finding a portfolio that works on autopilot. And by autopilot, I don't mean just going and necessarily turning the keys over to an advisor or a robo-advisor to do all the work for you so you don't have to think about it yourself. I think about it more about designing a portfolio so its inherent design is self-driving and auto-correcting. So when you have a portfolio that has the characteristic of being on autopilot, that gives you a lot of the confidence you need that no matter what happens in the world, if the economy goes great or if it goes really poorly, or if stocks do great and gold crashes, or gold is awesome and stocks kind of really flounder, no matter what happens, you're always set. So for me, when I look at portfolios, I always try to look for things that have that autopilot characteristics that look for consistency as opposed to just optimizing for some long-term average return that could change all the time.
In the UK, we've got this, well, I guess you could call it like a hit parade, or maybe, what do you call it, the Billboard 100 of portfolios, where they kind of have people who run their own portfolios and you can copy them. And yet people just tend to go for the ones which have performed best recently. And you can probably guess what happens. They implode after a short period of time. So how can you kind of avoid that implosion process?
Yeah, that takes a very special type of backtesting, and which is kind of the thing that first interested me in why I started Portfolio Charts was actually this exact problem. So I remember going through earlier in my investment experience, trying to figure out how investing works myself. And I would do the same thing where I would log into my Fidelity account and I would look at all the mutual funds going down on the list, ranked by performance by the last 10 years. And that's how, at least in the US, they're required to have that 10-year performance. And then you're like, oh, well, the one at the top, that must be the good one. So you always pick the ones at the top and you do pick a few of those and you feel like you're going to be great. And then inevitably, I feel like a moron. Like, why are they failing for me when they're working for everyone else? To really bypass that, it requires you to think beyond the last 10 years and not just thinking further back and ending on the same day, but thinking about every single start date. So one of the things that's I learned as an engineer is really understanding the concept of uncertainty. And so it's kind of like trying to predict where a lightning bolt is going to strike or a hurricane path. If you think about the picture of a hurricane when they draw out where it could go in the future, there's always a range of possibilities. And depending on when you start looking and backtesting, the performance of a portfolio can be very different, even the exact same assets. Like stocks starting in the 1980 looks like in the US looks like we're going to be compounding at 15% forever, and like, what's the big deal?
We still are. Let's keep going.
Yeah, exactly. But start in 2000, which is one of the worst times to start investing, which is when I graduated, and the worst possible place you can invest in the exact same asset. So what I do to help bypass that bias is all of the tools on portfolio charts are designed to, instead of just picking one time frame to study, like the last 10 years, or even picking one random cherry pick time frame like the 10 years from 1980 to 1990, is it starts in every single start year since 1970 and models every single length of time frame and overlays it on some pretty dense charts where you see literally every possible outcome at the same time. And by doing that, it helps you see the range of outcomes and not just a single outcome. And by doing that, you think it'd be like the super noisy and it's impossible to interpret because it's just a tangle of mess. But once you actually study it, you start to understand the nature of certain portfolios, where some are more consistent than others. Some have a very broad range of outcomes. Like if you just look at the stock market, it really could be up 1 billion% or down for 20 years. But if you look at a balanced portfolio like the permanent portfolio, it's like a classic example, it has an extremely tight range of outcomes no matter what start you start in. And so by understanding that, you can really better pick a portfolio that is most likely to succeed on your time frame no matter what happens.
It's interesting when you say most likely to succeed, because earlier you said the mistake a lot of people make is just sort of optimizing for long-term return. Like what portfolio is going to give me that average return that's highest over the longest period of time? And it kind of makes sense, right? When you first come to this, you think, yeah, that's what I want, give me the most money. But if that's wrong, and why is that wrong? What should we be optimizing for instead?
There's a couple problems with average returns. One of them is that it's pretty deceptive because the average return itself is not the return you experience. The return you experience in your own account is the compound return. And so you can have a high average, but if it's extremely volatile going up and down, if it drops 50%, you have to make more than 50% to get back even to where you were. So there's like a volatility decay. And so just the average return actually masks a lot of information about the experience, and not just about the emotional experience of I don't like losing money or I don't like the ups and downs, but the actual mathematical experience of how much money you're going to end up with in 10 years. It's going to be less than the average depending on the volatility. Sorry, I got ranting. What was the second half of your question? I want to make sure I get to it correctly.
No, it's fine. Like half of our podcast are trying to explain why maths hates us. So let's just carry on down that route. But like, I remember when we talked in our first conversation about retirement, we said that things you might want to look at are things like the safe withdrawal rate. Like what's the worst 30-year period you've had in the past and what could you withdraw from the portfolio safely? Or you might want to look at the Ulcer Index, which kind of measures the sort of depth and duration of drawdowns. So what are these metrics that we should be considering alongside return?
Oh, that's an excellent point. And actually that reminds me of my one specific metric that I like as an alternative to the average return, which answers your question about my comment about being more confident. I look at something I call the baseline return. That's kind of my own metric. But what it is, again, I look at every investing start date that I have data for, and I map them all out at once. And instead of just looking at the average, I look at the 15th percentile compound real return. Every compound return over time, even accounting for inflation. I crossed out like the bottom 15%. Like there are some outliers, they're just really bad times, and I'm not going to necessarily plan for the worst case all the time. That's kind of what withdrawal rates do. But in accumulation, you could give yourself a little forgiveness. But the 15th percentile return, which is the low-end conservative number, that's what I like to use to plan for as an alternative to an average return. And by doing that, if I plan for the baseline return for my own investments, 85% of the time in history, you would have actually exceeded that baseline return. So if I plan for that, and even if the baseline itself meets my needs, then the odds are in my favor that my financial plan is going to meet my needs in the future too. So a lot of that just goes, again, back to my idea of, or my philosophy of prioritizing consistency. And so some portfolios could have a equal average return, but based on the volatility, they could have very different baseline returns. And so by picking a portfolio, not based on the average, but on the higher baseline, you could find something that actually has much more desirable characteristics that are stacked in your favor to perform on your own time frame.
Now, it's interesting. If you choose the mean, that's really sensitive to outliers. So if you have some blowout positive returns, then that can skew the average up a lot. Whereas if you choose the 15th percentile, it's much more robust and it's not sensitive to those crazy outliers. It's kind of like if you had bad luck, what would happen?
That's true. The mean return can change all the time based on the endpoints of whatever data range you're looking at. And that counts for both average returns and even like compound returns. But when you look at more, I call it start date independent testing, that's much less sensitive to any one data point. So by looking at the full range of things and at like a percentile like the 15th percentile, it is much less sensitive to one random endpoint at the end because you're looking at the worst timeframes in history, not just the most recent one. So you're right. If you look at the average return and you update the charts every year, you'll notice that it changes all the time. But if you look at the 15th percentile, like the 15th percentile 15-year return, from year to year, it may not change because the worst 15 years can be a long time ago that hasn't updated in a while.
And to be clear, you're looking at this for a portfolio as a whole, right? How those assets are working together, not for individual asset classes.
Oh yeah, 100%. So that's one of the big pitfalls that so many investors get stuck into is looking only at each individual asset on their own and stressing about one of them doing really well or one of them doing really poorly and feel like they all have to stand on their own merits. But really, it's the portfolio itself that counts. It's kind of like, I think of it like baking a cake. And so if you only bake a cake based on putting in the ingredients that you take a spoonful and taste on their own, and this tastes good, you're going to skip the flour, you're going to skip the eggs. The eggs will probably make you sick. You're going to skip the baking soda, and you're not going to end up with any final product that tastes like anything you want to eat. You have to think more like a chemist or like a baker when you're thinking about portfolio construction. For every single ingredient has a role, and they're all important. And a corollary of that is when you're studying the actual results, you have to look at the portfolio as a whole and not stress about the individual assets. Because when you actually have a truly diversified portfolio, something's going to be doing well all the time, something's going to be doing poorly all the time, and that's actually all okay. And it's really only the final recipe that matters.
So what trade-offs are involved in portfolio construction? Like the obvious one we talk about is risk versus return, right? Mm-hmm. But there's presumably other things as well where you can't have everything.
Risk versus the return is the classic one. Although I think it's actually more complex than most even academics even give that credit for. People have written whole books on how you have to take the most risk that you can handle to maximize your return, and they treat it like it's some linear relationship, but it's really not like that. If you actually look at study the history and think in terms more of this baseline return type thing, you can actually get match very similar return levels with two different portfolios, but because they have different volatility, you can actually have much more desirable risk profiles just based on the portfolio design. One of the other big trade-offs, I don't know if I would call this a trade-off, but it's a thing, maybe like an emotional trade-off that a lot of people deal with. I do believe that the right portfolio for a person depends on a lot of their personality. And so there are trade-offs involved sometimes with picking a portfolio that may on paper have exactly the performance that would work for you, but based on other characteristics about the type of investor you are and the type of evidence you relate to and the type of even behavior that you relate to, like if you're more of a hunter-gatherer and you like to go out and pick stocks, if you try to present someone like that who's really into that with a purely farmer mindset, passive index fund portfolio, you can give them all the evidence that they want that it's going to work, but they won't necessarily stick with it because it doesn't match their personality. So there are trade-offs sometimes with when you adopt a portfolio, you have to either set aside some of your own instincts in order to be able to really stick with it and maybe hold down your base instinct to change sometimes, or you just need to upfront be honest with yourself and find something that's more appropriate that aligns with who you are as a person.
And in terms of who you are as a person, I guess one aspect of that is your amount of life left. So, if you're going to retire in, say, 5 years, you have a different portfolio, presumably, than if you're going to retire in 40 years.
Yes, that's true. So there's definitely a time aspect to it. Everyone has phases in their life when they go from the accumulation phase and trying to make as much as they can and save up. But once you reach retirement, your priorities do change. You're much more concerned with protecting the money that you've already have when you're not going to have any more opportunity to add to it or much less than you did before. On the other hand, I actually personally have a different perspective on that than a lot of portfolio people that you may talk to. That from my perspective, it's hard enough to find one portfolio in your whole lifetime that you truly understand and relate to and enjoy and can stick with even in the bad times. And so once you find that, switching it just because you're retired isn't necessarily the best choice, because the odds are you're actually going to switch it to something you no longer relate to, and you're increasing your odds you're not going to stick with it. So from my perspective, because I focus on, again, on consistency, I'm a proponent of picking one portfolio early on that you enjoy, that's consistent, that meets your needs. And it just so happens that those consistent portfolios are also fantastic retirement portfolios. So by picking a portfolio that's consistent and taking all that optimization energy that a lot of investors spend on trying to tweak their portfolio and add leverage and find exactly the right fund, if you just pick something that's super consistent and you focus your energy instead of on optimizing portfolio, on optimizing your savings rate and piling more money into it over the years and focusing on your career and trying to get the promotion and the raise that you need, you're going to come out much further ahead. And it also makes retirement a whole lot easier when you're not having to think about not just changing your whole lifestyle from working all the time to retiring suddenly. And when you pile on top of that, you also want to switch your portfolio too, like completely, and mix everything up. That could be quite a bit. But if you set yourself up with a portfolio you like that's consistent to meet your needs, as you approach retirement, you even start prototyping your retirement life and start living that way so that you're to the best of your abilities before you reach that retirement date. And then by the time you reach retirement, it's kind of like just turning off the faucet, but the garden is still xeriscape now fully, and it takes care of itself. That's a much different mindset than like trying to always optimize for one thing or the other. Consistent portfolios are really good at both, accumulation and retirement.
That's really interesting because, correct me if I'm wrong, but the typical advice you might hear would be something like, when you're young, take as much risk as you can. Mm-hmm. Have as many stocks as you can in your portfolio, maybe 100% stocks. And then as you reach or get close to your expected retirement age, you'll have a glide path, they might call it, which tapers down your stocks and builds up bonds and other assets to smooth the ride. Mm-hmm. But you're saying there's a case, even early on as an accumulator when you're young, for this kind of highly diversified, all-weather style portfolio?
Absolutely. So that is the typical advice by far. And that's what most people, I think it's probably in the CFA curriculum. So that's why everyone who has been educated will teach you that's exactly what you're supposed to do. Do 100% stocks when you're young, pile money into it, and then only get conservative like as you get older. And that goes back even to some of the old school advice, like taking out your agent bonds. So that's the way to express the glide path of becoming more conservative over time. But what that neglects is the emotional side of investing all along. Is that the young person who is actually okay with that and who is okay with the risk and watching their accounts drop 50%, which has happened in my lifetime, they don't suddenly necessarily become more conservative when they're older, even if they should from a retirement perspective, but it's in their personality to be okay with that. And the flip side of that is there are plenty of people, me, myself included, who are never comfortable with that level of volatility, even in accumulation. So by picking I guess you can call it a more conservative portfolio, but I would call it more of a balanced or consistent portfolio. That gives me the confidence to stick with the plan, even in accumulation. And once I figured that out for myself, that really supercharged my own accumulation path, because I stopped worrying about trying to tweak funds and pick things and maximize the average return, even if it has, underwater for 15 years, which does happen.
Now, one thing that there's a lot of conversation about in our community at the moment is about de-risking, because we see very high valuations. People are very scared. Cryptocurrency is sold off. That's often seen as a canary in the coal mine in terms of risk. So I've been trying to tell people to stick with the plan. But do you get people saying, should it be dynamic based on valuation, or should we just stick with a strategic set of weights?
Yeah, there are always people that really get into the valuation argument. From my perspective, the people who focus on the valuation tend to be more the academic side. So if you're talking again about mindsets, there are multiple types of motivations that go into how people invest. The academics tend to really get into the theory. And so the theory of asset pricing and why they believe investments should behave and how they can explain how they can behave. And so when you're really into theory, the things like worrying about the CAPE ratios and everything is something you keep a close eye on. It could cause a lot of worry. For me, I'm more of as opposed to a theorist, this is the difference between like a physicist and an engineer. Is the physicist is into the theory and engineer is into the proof. So you can have all the best theory in the world, but if you can't measure it, then your theory needs improvement from my perspective.
You know Roman is a physicist, right?
I do.
PhD in physics.
Yeah, at 100%. And he knows I'm an engineer. But this is a classic mindset clash, and the thing is, I don't disagree with Raman. I respect Raman like tremendously, but this is why you need multiple types of brains on the same type of problem to be able to provide different perspectives. The whole theory versus proof. So, yes, there are always people who think that you should adjust things based on CAPE ratios. From my perspective, if you look at the evidence and the proof, as there are ways to set up a portfolio so none of that matters. Not that it doesn't happen, and not that evaluation isn't real and isn't a thing that you should be concerned about. If you're heavily concentrated in something like stocks, then the valuations matter a whole lot more. If you're widely diversified in a portfolio that is diversified across different assets that respond well to different economic conditions, so stocks and bonds and gold and things like that, then the valuation of any one thing matters a whole lot less because you're already covered. Harry Brown, he's the author of The Permanent Portfolio, which is really built around this mindset of designing a portfolio built around different economic conditions. He describes it as building a portfolio with firewalls. So a firewall is something like in a building or a ship where even if one compartment catches fire, the walls are built to wall that off and protect it and contain it to the damage to only one section and not burn down the whole building. So the portfolio that's widely diversified also has economic firewalls built in. So like your permanent portfolio, even if stocks are doing terribly for 20 years, that's only 25% of the portfolio, and the other 75% are in very different things that respond differently. So by picking a portfolio that is diversified across those things and has firewalls built in, then from my perspective, you don't need to be so worried about trading in and out of any one individual asset based on how the economy is going, because you've already set yourself up to succeed no matter what.
This episode is sponsored by Freetrade. Right now, you can get 2% cash back when you transfer £10,000 or more in pensions to Freetrade. Switch to one of the UK's cheapest SIPP providers. With a Freetrade pension, there's just one flat fee, zero commission, and access to over 6,500 stocks, bonds, and funds, all in one easy-to-use investing app. Visit freetrade.io/pensioncraft to start your transfer. Capital at risk. Other charges may apply. SIPP eligibility rules and terms and conditions apply. Cashback is capped at £1,000 per customer, and the offer ends 31st of December 2025.
So the title of this episode is How to Pick a Perfect Portfolio. Now you're saying it should be balanced between different asset classes, which all bring something to the table and work together. Fine, that makes a lot of sense. But then there's a lot of different portfolios that claim to do that. You've mentioned the permanent portfolio, you've got the golden butterfly, you've got pinwheel, you've got all weather, you've got millions, right? Millions of different possible permutations. Is there such a thing as a perfect portfolio for a person? Or is it just a matter of picking one of these things, which is close enough?
That's a really good question. And there's a specific nuance that I want to point out, at least, because I say this a lot. And I definitely 100% believe that there's no such thing as one portfolio appropriate for all people. So if you talk to many investment people who talk about portfolios, they tend to have one thing that they're pushing, one portfolio style that they're pushing that they know about, that they're selling books for, and that they are confident that everyone should invest in. And I'm not a believer in that whatsoever, because everyone is just different and everyone has different needs. Everyone has different concerns. And so the idea that you should be able to pick one portfolio that works for everyone is just a poor idea. And that steers a lot of people wrong. But on the other hand, I do believe that there's probably a right choice for each person. And that's the investing journey that everyone goes through as they learn about investing, is to try to find that one right choice for them that does work for them and that they do understand and that they have conviction with, that works for their needs and that they're willing to stick with no matter what happens, even in the bad years when your choices are going so well, but it's the right choice for you, so you're going to stick with it. And that's the hard part. And so I don't want to like minimize how much effort it takes to get to that point, but I do think that that's something that's important, because once you actually do find a portfolio that you truly understand and you relate to, investing gets so much easier.
So we've talked about risk, we've talked about return, and we've kind of got to the point where maybe investment horizon's not so important in your opinion. What other things would you consider when you're trying to find something which is a comfortable fit in terms of portfolio?
That's a good question. I think the first place I would start would be in drawdowns. So I have a specific chart on the site called the Drawdowns chart. And what it does is it measures both the deepest drawdown in history, like the compound drawdown, not just in a single year, but how low can it go over time, and also the longest drawdown. So does it stay down for 3 years? Does it stay down for 15 years? Those are very different experiences. And so you can measure that for any portfolio looking at all the data and history. And when you do that, you start to get a good feel for that, helps you understand your own, people call it risk tolerance. It's much more visceral than just looking at a standard deviation number. It's like, put yourself in the shoes. Okay, I invest this way. I can show that at some point in history, it lost 50% and was underwater for 13 years. That's actually the US stock market that most people default to and say everyone should invest all their money in when they're young. But as a young person, if you're you're working hard, you're busting your tail, you're putting your life savings into a total stock market fund, how are you going to feel when it's down 50%? And how are you going to feel when the realization that it may be more than a decade before it even gets back to where you started? And so by looking at the historical data, it's not just about optimization. It's not just about looking at numbers. It's about putting returns in context and thinking about how you're going to feel when you're in that situation. Someone in history experienced that exact thing, and it could be you too.
How about up crashes? Because weirdly, the thing which I've noticed is that people get really nervous when we get these huge rallies like we've just had. And if anything, that makes them more likely to shift out of the portfolio than a crash. Maybe because they're trained not to do that. Is that something you've come across?
I think I've come across that less. And it might just be a natural selection bias for the people who read my type of work. So I 100% can understand that worry if you're normally thinking about single assets. If you're normally thinking about stocks and stock picking, and if things are like going through the roof, then, oh yeah, I could see how I might be worried. I'm going to have to switch gears because my choice seems like it's getting out of hand. When you pick the type of investing style that I promote, of like this diversified portfolios of very different types of things, it has a built-in natural rebalancing thing of whenever one thing does go crazy, like gold is going bananas right now. So someone holding the golden butterfly has had a fantastic year because gold is going nuts. But if anyone was like just investing in gold on like some, account on the side trying to predict it, then oh yeah, sell, sell, sell. I'm getting worried that this is getting too out of hand. But the golden butterfly or any other portfolio that holds gold, you're going to rebalance at the end of the year. You're going to sell that gold at a great profit, and you're going to buy more of the things that are low. So it's naturally self-correcting. So every single time you rebalance and you sell high and you buy low, and that's just part of the natural process you use, that takes a lot of the stress out of trying to predict, should I sell, should I not? Like, no, it's out of your target percentages, and you just do it, and it's okay.
So when you're thinking about what portfolio is right for you, we've mentioned things that typically people might have to think about: their time horizon, their risk tolerance, but also their personal financial situation, I guess. So if someone owns a lot of rental properties or has a big defined benefit pension, or maybe even a large inheritance that they're expecting at some point, does that kind of thing change what might be the best portfolio for them?
Sure, I could see that. So there's definitely, like, when you kind of think about your own financial needs, the classic example that we talked about before is withdrawal rates. Once you're retired and you have a certain expense needs out of your portfolio, the portfolio you choose can affect your withdrawal rates by quite a bit. You definitely have to think about whether the portfolio you choose when you're figuring out your retirement income plan. But even beyond that, when you're talking about accumulation too, I do think that, yes, your personal situation can affect like the types of things that you might be okay with. Even think about the golden butterfly. So the golden butterfly has 20% short-term treasuries in it. You think of it as cash. As a reference portfolio with 20% cash, that's actually a good thing for a lot of people, and it helps balance the 20% in long-term bonds. But if you're for some people, once you have a certain amount of savings and you have different goals, having fully 20% cash in portfolio may not honestly be a requirement for all people. So if I were to take one part out of the golden butterfly, if I was looking to tweak it, maybe take some of the money out of cash and you could put it into real estate. You could put it into more stocks. You could put it into, even if you have some speculative investment you want to do yourself, that may be the portion I would take it out of. So there's always some tweaking that goes on with like how you pick a portfolio for yourself, which is an important reason why on portfolio charts, it's not just about reporting 20 different standard portfolio recipes. I also have lots of tools where you can tweak it down with the percentage for yourself to find something that works a little better for what you're looking for.
If you have a couple, I've noticed, I know I speak to a lot of people about this. If you have a couple, what I often see is a very different appetite for risk. So one person really wants risk, the other person doesn't. Is it better to have two separate portfolios or come up with a kind of compromise portfolio for the couple?
That's a really good question. That's a loaded question. I have to ask my wife what she thinks about that. So the engineer in me wants to say that there's probably the best choice to think about your total savings as a whole. Once you're married, it's your aggregate portfolio. When you start separating them into two different buckets, this is the safe one, this is an aggressive one, that may feel good and it may help you feel good for yourself. But really, as a couple, your goal is to combine your resources into something as a team. And so it's better to think about as your whole thing. From a purely personality or from a psychological and marriage perspective, I also appreciate the need to have different accounts that you manage differently. And everyone has different reasons for that. And I'm not going to judge. But practically speaking, just like I would say that, you should think about your portfolio as a whole and your retirement accounts and your brokerage accounts and all these different accounts. It's really one big portfolio, not just a bunch of different portfolios. I would generally say that for a couple, you probably should think about your combined investments together. Even if you manage them separately for purely separate reasons, like your wife's really only likes a certain type of investment because she has a different personality and she wants to manage it that way in her retirement account, cool. But when you're thinking about your total savings as a group, look at your total portfolio for your combined money and kind of use that for your planning purposes.
I think you kind of have to, don't you? Like if you imagine a really extreme scenario, one person is super risk averse and is like 100% cash and the other is really risky and 100% stocks.
Yeah.
You do that for 30 years. One person's in 5-star hotels and one person can't go on holiday, right?
Yeah, but which is which, Michael?
Yeah.
But let's actually be honest and think about it. Most often I see it when you're talking about the situation, it's the flip, where you have the husband in the relationship is reckless with investing and he's trading penny stocks. He's throwing it all in crypto and making huge money and losing it the next day. And the wife is actually the one like, what are you doing? And so I'm not going to do that. Do not touch my money. I'm going to manage mine responsibly. In that situation, 100% you should have different portfolios because one person is actually not being a responsible adult.
Now, again, speaking to people, a lot of people at the moment are talking about private credit, private equity, alternative asset classes. Now, you've got a very empirical approach to investing, and there isn't a lot of history for some of these asset classes. So how would you approach that? Or would you just avoid this stuff?
It's true. I don't have a lot of data for those things, so it's a limit on my ability to speak authoritatively on things like private credit. I have good data for things like gold, for broad commodities, and for REITs. But when you get to other things like private credit and momentum, even beyond alternatives, so some of those type of things have a lot of interest today. And I wish I had more data. And once I find it, I will add it, and I'll be able to speak to that. But the way I would handle that, even for things that I can't vouch for, I mentioned Harry Brown earlier. You could tell he's a big influence in my financial education. He had his permanent portfolio that he promoted, but he also said it was a good idea to have a variable portfolio to go alongside it. And so what that means is you take most of your money that you can't afford to lose and you invest it in a steady, dependable portfolio that's you can count on to be there when you need it. And then whatever percentage that you can't afford to lose, in his mind, but people probably argue, I can't afford to lose anything. But there's maybe it's 10% of your money, and you want to invest in private credit because you believe in that and you think it'd be a good diversifying thing, then go for it. There's good evidence from a lot of very intelligent people that shows that that's the type of asset class that could help benefit a portfolio. But by building in a little bit of that firewall where you have your most of your money in something that's going to be okay, do private credit. It's probably going to help. And on the off chance that there's some historical thing that's going to happen that's going to ruin it, and we just don't have the history to know how that's going to happen, you're still going to be okay in the process.
So going back to the core portfolio, the bit that you're really relying on for most of your assets, when people are putting that together, what are the biggest mistakes you see from people?
Let's see. I guess one mistake would be, like we talked about early on, evaluating portfolios based on a single time frame. So if you're only looking at your portfolio list and you're going to rank them by which one performed best in the last 10 years and invest your money in that, you're just resorting to the same mistakes that all people do, being too dependent on one recent time frame and have the recency bias, and you end up regretting it later because in the next 5 years, a different portfolio will be ranked at the top. But another mistake I think people make is picking an investing style misaligned with their personality. So you'll have someone like me who's probably, I've learned over the years, is naturally more of the farmer mindset of I want to manage my crops and the different index funds. But as I was younger, learning about investing, it's like, okay, I'm going to go and try and pick stocks and be like Warren Buffett. And like, I might even as an engineer be decent at it, but it would make me miserable. And it'd be something that I wouldn't be able to stick with over time. Because of that, you end up kind of churning even not just your portfolios, but even your investing style. I mean, I guess I could call it a mistake that you shouldn't have done that, but that's also just part of the learning process. And I do think that kind of thinking about those things and how you are wired to think about money in general, by thinking about that up front, you can set yourself up into a better chance of success.
Do you find that in the US, people tend to have a very US-centric idea about investment, even down to the naming of funds, international funds in the US and non-US, which is funny to us. But do you notice that there?
Oh, 100%. It's actually, when I'm researching portfolios and adding things to my site, it's the biggest pet peeve, and it's actually quite a challenge for me, is even all these investing authors writing about portfolios, it's like almost exclusively from a US perspective. So that's why you have such the US bias in stocks, where a lot of portfolios have no international diversification outside of the US at all. It goes into even how they talk about bonds. Like some countries, the US bond market is very different from the bond market of even different countries in Europe. That bias is like pernicious in the US, and it makes it very difficult to talk about investing in general. So we'll say that, like, if you're talking about UK portfolios, the way I would, even looking at the portfolios and portfolio charts, and if you're looking to tweak them for a UK investor, the things that I would look at is international diversification outside the UK is more important when you're not in the US than when you are in the US. And if it's not like a US bias thing, it's really just it's because the global market is so much US anyway, that you're talking about totally different things. You're talking about international from a US investor perspective and international from any other country in the world. I think in the US, historically speaking, has taken up anywhere between 40 and 60% of the global stock market. And any other country is probably no more than 5% at any given time, for the most part, unless you're talking about some very rare situations. So for as UK investor, I would definitely look at, even in things that would normally are written for a US investor, at least include some international diversification in that. It could be a global fund or it could be a European fund. Either one of those would be much better than just sticking with yourself. At the same time, one thing I would caveat is that from all the research I've done, it's still important for a investor, no matter what country they're in, to at least have some home country bias in their stocks and bonds. And that may even also be counter to some arguments from people who say, just invest globally, and that's the way you should do it. But I've seen this in withdrawal rates. I've seen this in drawdowns. I've seen this in all kinds of statistics, and you can test these for yourselves on portfolio charts. That if you just look at 100% global versus doing like 10 or 15% within your home domestic market, it almost always helps returns. And the reason for that is actually very simple. It has to do with inflation and exchange rates. So the markets don't happen in a vacuum. The inflation within your home country is not completely independent of the stock market returns in your home country. And if you attach the engine of your portfolio returns to a country halfway across the world, and you have basically no influence because of the weightings in the markets of your own country, then your portfolio may not actually be tracking your local inflation and currency the way it needs to in order to maintain your own purchasing power. So having some amount of home country bias in your portfolio as a UK investor is a good thing, while still investing internationally is also a good thing, so you're not overly concentrated in a single country.
Should you be concerned about currency? Because if you're someone who lives in two countries, maybe you'd handle things differently. Or if you live in emerging markets, maybe currency is more of an issue.
Well, expats will always have that type of issue of like trying to split in different countries. But I'm not even talking about that. I'm just talking about even as a UK investor investing in US stocks. If you read a book about a portfolio that's written from a US perspective, which they almost all are, they're going to express their returns in terms of the US dollar and in terms of US inflation if they're talking about real returns. You can take the exact same index of US stocks, but if you're a UK investor and you have UK inflation, which is different than the US, and you have your UK currency, those exchange rates and then inflation rate means that for the exact same index, you could have extremely different returns and performance and behavior portfolio. That's why I say it's important, not just for I'm like an expat and I'm living in a different country and I need to know how to do my exchange rates. Like, no, it's the data itself that you're depending on to make a decision. If it's expressed in US dollars, but you're not translating that to British pounds, then you're actually not looking at the real numbers for you.
Okay. Final question, provocative question. What are the portfolios you think are overrated?
Oh, okay. This is good. So the number one that comes to mind is just the VTI and chill. It's just put all your money in stocks in a single stock fund and just
ride it out.
Bite down, diamond hands, never let go, never sell, and you're going to be fine. I think that's super overrated, not just from an emotional perspective, but also from a performance perspective. I have a tool on the portfolio charts. It's for members, but you can find lots of references into an article. It's called the Portfolio Matrix. And it shows the performance of all the different portfolios all ranked on the same chart. And the total stock market portfolio, it has the best average return, which everyone was attracted to that. But on almost every other metric, it's at the very bottom. So that's like one that I think is very overrated. The other ones that I'm personally not a huge fan of that I think probably are overrated are things like just building on the total market portfolio, like the classic 60/40 or the 3-fund. While those are improving and they have the right mindset of trying to diversify away from stocks, they're a bit overrated in the way people are kind of like married to them, like there's some kind of natural law. Like Jack Bogle talked about stocks and bonds, and so I should never invest in anything else. Like that's kind of short-sighted, and there are other better ways to approach it.
I guess the thing they have going in their favor is they're simple, right? They don't have the complexity of rebalancing between 6 assets or something.
True, but the rebalancing between 3 assets is not that different between rebalancing between 5 assets. All the portfolios I talk about, I'm not talking about value and CAPE ratios, doing timing, when they buy and sell, signals. It's none of that. It's all this exact same Boglehead mindset of buying a handful of low-cost index funds, rebalancing once a year, and otherwise leaving them alone.
Well, the thing that's complicated for a UK investor is that some of these asset classes you struggle to access. Like if you're trying to do like small cap value, like it's not as simple as you might think. Like US investors, I didn't realize that.
No. So I totally get it. So one of the things I did just in the last year is I added a new section to the site called Assets. And I did way more work than you probably realize, looking through every possible ETF that you can invest in that matches my data, these asset classes, not just in the US, but like globally. You can go there and filter for the UK for ETFs available in the UK that match things like small caps and small cap value and long-term treasuries. And it'll give you the list of that. So I know from that exercise, it gave me the respect for the pain that European investors have to go through to find some of these things that US investors take for granted. So things like small cap value are difficult to find. There are a handful of funds, I think, in Europe that maybe do that. But if you're looking for an alternative, I think the next best thing would be either like a value fund, a large cap value. There tend to be a little bit more of that, or just a small cap blend. Those tend to be quite a bit more common than small cap value in particular. So I would say don't get hung up on the idea of a perfection, like it has to be exactly small cap value, exactly with the same type of filters that the US has. Look for things like small cap blend that's still quite close, and you can even test the numbers on the site, and that'll still be a very valuable step in the right direction.
So we talked about diversification, we talked about risk, we talked about long-term perspectives. If you want to discuss this and you want to discuss it with like-minded people, you can do that very easily. Just go to pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Does rebalancing improve returns? So you mentioned, Tyler, the kind of default assumption in portfoliocharts.com is that you rebalance once a year and bring everything back into the line with their target weights. Does that actually help? What happens if you don't do that?
So I know you call this a dumb question. This is actually it's not dumb at all. And it's actually surprisingly complex. So let me see if I can properly put this into context. The short answer is yes, it does improve returns, but it's not always immediately obvious. The act of rebalancing, what it does is it helps you buy low and sell high, which is a thing that all investors, like you're trained, or even as a child, would say, buy low, sell high. This is something that's a good thing and would actually improve your returns. But the rebalancing itself it's tricky for people to understand how this would help because it's not always as clear as you want it to be. There are situations if you're rebalancing two different assets where it can have a very unexpected return that comes out of it. The first person that kind of showed this was a man named Claude Shannon, who is a famous electrical engineer who, beyond just being like a totally brilliant person who invented a lot of the computer systems that we all depend on today, he thought a lot about investing, and he came up with the idea of something called Shannon's demon. And this is a mathematical proof where he was taking one asset that was like a zero return cash account, and a second asset that was just like randomly go up 5% and then down and then up and down. And both over time on their own would have a long-term expected return of exactly zero. And if you just held both of them without rebalancing, you would expect to have a long-term return of zero. But the simple act of rebalancing, if you measure that, once it went up, you sold the one that went up to buy more of the one that was low, and then you keep rebalancing it over time. If you watch the account value, it grows at about 2% a year. So that weird thing, he gave it the name Shannon's demon, which is kind of it's a thermodynamic tilt of the hat to an old thing that happens in engineering too.
Oh, mate, that was physics. That was Maxwell's demon. That's physics.
Oh, okay. Yeah, no, you're right. So it turns out that when you look at physics and engineering, there's a lot of demons involved. This math drives people crazy. What it is, it's really just a mathematical thing. It sounds like it shouldn't be happening, but it really has to do with how the equations work, where by reducing the volatility of something, but still rebalancing it, you actually can, quote unquote, generate returns over time. That's really just about improving the risk-adjusted returns. So an extreme example of this in history is if you look at, I'm going to take an example portfolio, and this is overly simplified, of 50% stocks and 50% gold. So in the 40-year time frame, starting in 1970, stocks had a real compound annual growth rate of 4.9% a year. In that same time frame, gold had a growth rate of 4.0% a year. So if you kind of try to predict in your mind of if you had a portfolio of 50% stocks and 50% gold, what would that growth rate be? You'd think it'd be...
Yeah, you'd expect like 4.5%, right? That's what you'd expect.
Yeah. But if you actually measure it, and what it was using actual historical data, it was 5.8%. So the act of rebalancing generated nearly 2% return over stocks alone. And so it's totally counterintuitive and blows your mind that how does that even happen? And theoretically, if you think about, the weighted average return, it shouldn't be happening. But in the actual real world, because the way compound growth works and the way rebalancing works, it does happen. But the thing is, that's like the extreme example. And most of the time, if you go and look at the two different assets and you're rebalancing, you're not going to have the rebalance return of both of them be higher than one of individual one. But what it does do is it affects the risk-adjusted return. And what that means is, like you said, between these two, you expect the actual return to be 4.5 if the one is 4 and one is 5. Most of the time, it's probably not going to be 6. But almost always, it's going to be more than 4.5. It's going to be closer to the higher one you think. And by having a portfolio that's diversified that you're rebalancing, you can have closer to the higher returns than you think, but with lower volatility. And so by being able to improve the volatility to reduce the drawdowns, you can have a much better portfolio without the trade-off of the returns that you think you might have.
So you are sacrificing some of the average return of the assets, but you're benefiting by reducing the volatility by more. So it sort of outweighs the reduction in return. Is that right?
Yes. There are curves for both where you reduce the return by a little bit, you can increase the stability by quite a bit. And for every individual person, there's a crossover point where this is the sweet spot for you. But the important thing when it comes to rebalancing, and the concept to keep in mind from Shannon's Demon, is it's not a linear relationship. So just because you decrease the volatility by half does not mean you decreased your average return by half. It's actually somewhere in between where you're keeping much more of that better average return than you probably think, and you can still make your portfolio much more desirable to hold on to.
And just to talk about the ingredients that makes this work, you've got to have volatile assets, which almost all assets are. The trading costs have not got to be too high, or you do it infrequently, so it doesn't matter as much. And I think the third thing is that they're uncorrelated assets, so they kind of zig and zag at opposite times, ideally. Are those the ingredients?
Yes. So the most important thing, and this is not just me looking at it, like other people like Michael Kitces has looked at this too, and he's written articles about it, is that you want to find assets that are equally volatile, and highly volatile preferably, and uncorrelated. And that's harder to do than it sounds. Like, you may say that I'll just get a large cap growth and a small cap value stock, and they're two different asset classes. Now I'll rebalance, but it's not quite the same because they're still quite correlated. That's why the example of stocks and gold is such an extreme thing. It has such weird results because that's about as equally volatile and completely uncorrelated as you can get. And the other third asset that usually comes into is some kind of long-term treasuries or long-term gilts. Those tend to be very highly volatile and also kind of uncorrelated to both stocks and gold. So those three things together tend to be what I call the three secret ingredients, that if you kind of add those type of things to a portfolio, you can really get some of these nice returns over time.
And is annual rebalancing the sweet spot here?
So this is another example of where lots of people have different opinions on this. I stick to annual balancing, frankly, because my data is annual. If I were to get into monthly data, and there might be some different ways to look at it where, a monthly rebalancing, or you can have rebalancing bands. People have lots of theories around that, where you only rebalance when you reach certain deviation from your target allocations. But you see this behavior in annual rebalancing. That's a very simple way to model it. And if I'm being honest about my own portfolio when I'm rebalancing, I'm not necessarily mechanical about that either. Like, I tend to be very careful about taxes. So just trying to rebalance only when you need to, be smart about it so you're not paying more taxes than you have to, and just be intelligent about it. Your goal is to keep it balanced over time, but it's not necessarily about being such a robot about it that you're not being smart about it.
Well, thanks again, Tyler, for coming on the show. It's such a pleasure to speak to you again. And I just love your website, Portfolio Charts. For me, I've just been out for a tasting menu, and it's a little bit like that. Each of the graphs is like one delicious little meal in itself, but the whole thing is just a beautiful, beautiful smorgasbord of graphs. So thank you so much for producing the website.
Well, I'm glad it's so tasty, and thanks for having me. It's really an honor to be here, and I'm a big fan of Many Happy Returns myself, so happy to be back anytime.
Brilliant. Thanks so much. And it's good to hear your diet's still on track, Roman.
I had one blowout, all right?
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.